Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklo.
And I'm Alex Collins.
And on today's episode, we're going to be going through the 3 portfolio mistakes that we see most often.
Yeah.
It's anytime we're going through our clients' investments portfolio, these are the top 3s that come up really kind of over and over again. And I don't think it's necessarily anything our clients are purposefully doing. I think it's just what they hear in the media and what they know to do. And a lot of it is just a knowledge piece that they didn't know that was there.
Yeah, absolutely.
So, before we dive into it, though, Mr. Collins, I heard you crack open your beer. What are you drinking?
So I found a Mac and Jack's IPA. And so Mac and Jack's is one of the breweries that introduced me to craft beer way back in the day. And so this is the August Bay IPA from Mac and Jack's.
I like August Bay. That's a good one.
It clocks in at 6.3 with percent with 70 IBUs.
Awesome. Well, I am drinking a Black Raven Samish Hazy IPA, which clocks in at 7.1. And I think it's 41 IBUs, 45 IBUs. So Black Raven, shocker. But cheers.
A hazy IPA, go figure. The Samish is a good beer, though.
Yeah.
I like that one.
So let's dive into today. So actually, real quick before we dive in, Alex, let's remind everyone, we've got a YouTube channel. The visual side, I think, is becoming more integral to some of our topics. Today's topic is definitely going to be a piece that we think you should see the visual side. So if you're listening to this in your car on Apple or Spotify, you might want to re-listen to it or re-watch it on the YouTube channel. You can head over to beerandmoney.net and you can actually see the link to the YouTube channel there so you can watch the visual side of stuff today.
Well, and we've also got Andrea on our team cutting it down into some shorts. So if you want just the pocket-sized version of some of this stuff, that's there for you too.
Absolutely. So let's dive into it. So when we're investing, it's important to understand what we're investing in.
Yes.
And we laugh at that, and even our clients laugh at that, kind of like, no joke, Ryan. And they use a different word than no joke. But we look at their portfolios, and what we're analyzing is okay, what companies, what asset classes are you invested in? And by asset class, we mean there's large companies, there's small companies, there's international companies, there's different asset classes, and we're wondering how much of the portfolio is in these asset classes.
Well, and like when we're talking about small companies, we're talking about publicly traded companies that are worth up to $2 billion.
Yeah,
so
it's not Mama Mia down the road. Although there probably is a Mama Mia out there. It's not your mom and pop down the road. So
right.
I just watched Friends. Mama Mia was the some restaurant there in Friends. But anyways, that's beside the point. So let's jump into this, right? So when we look at portfolios, we're looking at where they're invested or how much of their money is invested in a particular asset class. So let's just say we've got $1 million portfolio, and we're just going to take a look at study period here. Doesn't really matter. It's not the point of today's episode. And you're seeing different asset classes on your screen. And for those of you listening, the asset classes, and these aren't all of the asset classes, so I want to be clear about that. But these are the most common ones. We've got treasury bills, we've got government bonds, we've got United States large stocks, United States small stocks, United States large value, and United States small value. And then we've got international large stocks and an international value. There's many others. These are just the ones that we're going to go over today. And mainly a lot of these are what we see in our client's portfolio. And when we look at this, Alex, I don't know about you, I do know, but I'm going to ask the question anyways. When we're looking at our client's portfolio, where is most of their money invested?
In terms of stocks, it's almost 100% U.S. large stocks.
And why do we think that is?
It's what they're familiar with. It's what they're comfortable with. They're being told to index invest, and they're buying the S&P 500.
Exactly. So this is the S&P 500. And so if this person invested money, 1973 invested in this asset class, this is putting all of their money in this asset class. Just so there's a quick disclosure, we would never suggest all of your money going into one asset class.
Correct.
But this asset class has done relatively well over time, right? The $1 million has grown to 162 million.
Over a 49-year time period.
Over a 49-year time period. And you can see the difference. Now, red doesn't necessarily mean negative. Like this one's 31.7% positive in 1985. They just missed out on the best asset class that year, which is 56.72% in international large stocks. We're going to get to that in a minute. Back to the S&P 500 US large stocks. This is what the media heads are all talking about. Like the first thing you hear if you go to any financial news media source, they're literally going, well, the S&P is up such and such, or down. It starts with the S&P and it almost ends with the S&P.
This used to be the Dow, and they moved from the Dow to the S&P, which is a better move. I used to ask clients how many stocks were in the Dow, and very few people actually knew that it was only 30 large industrial companies.
Yep.
And industrial is a questionable naming convention there.
And what's even more interesting about this, so this makes sense. And, a lot of our companies, our clients are working for tech type companies, Amazon, Google, Facebook, right? Microsoft. And so they're also investing maybe in their stock option plans, RSUs, all that kind of stuff, and keeping those and staying invested in those companies. And when they choose the different mutual funds, they're also choosing the US large stocks. So not only is their income coming from one company, a large portion of their individual stocks is in the company that they work for. And then that same company that they work for and getting paid from is also in these different mutual funds that they're also purchasing. Maybe a target date fund, for example.
Well, and one of the things that we've had a tremendous amount of conversations in the last, 5 years with clients, where we're talking about what the makeup of the S&P 500 is. And most clients understand, it's the S&P 500. It's 500 large companies in the US, which is awesome. That's way better understood than, say, the Dow. The issue that we find is that most people don't understand that the S&P 500, that if you take a look at the top 10 holdings, that's between 35 and 40% of the overall index. And all of the Mag 7 or the Magnificent 7 tech companies are in that top 10. So you have almost a third of the portfolio is invested in those tech companies, whether it's Nvidia, Microsoft, Apple, Amazon, Google, Facebook, Tesla. We wind up with this just massive concentration. And then oftentimes clients are then compounding that concentration by holding on to company stock. We work with a lot of, we live up in the Northwest, so we deal a lot with Amazon, Apple, Microsoft, Google. A lot of these bigger companies have very significant presences here in the Seattle area.
So mistake one that we're enforcing and reinforcing is over-concentration, right? And that being oftentimes what we'll see, and we'll get to this and we'll show you exactly what we mean. It's invested in US large stocks, okay? So that's part one. Part two, as we've already started to go into, is this thing called overlap. Meaning you work for such and such tech company and you've invested in these different mutual funds. And, they're all named differently. I'm not going to name names because we're not suggesting any specific mutual funds for compliance purposes here. But oftentimes when we go in and we get into the weeds of what each mutual fund is invested in, you might have 5 mutual funds that you're invested in. And in those 5 mutual funds, they might all be investing in the same companies or the same asset class, such as US large stocks.
In fact, it's almost a given that there is a very significant amount of overlap between the different mutual funds, depending upon like we've actually seen clients who bought, 3 different index funds and were then surprised that they owned the same thing. That one surprised me a bit, but like at the same time, when we start looking at under the hood of these different things, a lot of times people are surprised that they wind up owning kind of the same things. And there's some reasoning behind why they own the same things.
Yep. And so just to I know this kind of sounds like what we just discussed is overconcentration. It might be a different asset class that they own that also is invested in the same companies, right? So maybe they've got some large value as well. But the same 2 mutual funds are invested in the same companies. So there's just a ton of overlap that we see oftentimes in portfolios. And when you talk about overlap and then adding in the overconcentration, your risk is getting bigger and bigger. And the whole point of having these different funds, at least when we ask our clients, is this thing called diversification. And then they find this out and they're like, well, we don't really have that.
Right.
Which then takes us to the diversification standpoint. And what is really interesting to us and as well as to our clients is when we start to show them how these different asset classes have performed over time. As we are staring at the S&P 500, the $1 million grew to 162 over that 49-year period of time. If they put all their money and they chose the large value category, well, now it's 307 million. I mean, that's almost double what the S&P 500 did. And then take one step further, if they put their money in the small value category, now we're looking at $1 billion. When our clients find out about those 2 categories, and this is not just so I'm clear, another disclosure, we're not suggesting that you put all of your eggs in one basket or chase these types of rate of return. We're just overlooking and really explaining these different asset classes have their own risk, have their own portfolio mix, and it's really the mix of your overall portfolio and the risks that you want is how we should clarify and classify your risk tolerance.
Just like working out, just like dieting, all of one thing, even if it's the most effective thing, does not make it a balanced diet or a good workout routine. We have to create balance so that we don't wind up with like huge thighs and like T-Rex arms. Like we don't want that. We want to be balanced overall. And so we have to go ahead and have a balance throughout. And now it's just a matter of like, okay, how do we change the mix of assets between all of the different various asset classes that are appropriate for you and your particular situation, as opposed to, oh, this one's done the best. There's a very, very good reason why all investment commercials say past performance does not predict future returns. It's because it's accurate and it's true.
So then when we talk with clients, we're talking about this diversification and chasing rate of return. We always ask, okay, the risk that you're willing to take, are you getting compensated for that risk appropriately? And so if we take that $1 million figure that we've been talking about, okay, and we analyze it from a standard deviation, which to this day, and I make this joke, but it's true, I hated this class. I was ecstatic when I got done with it. I can't believe I talk about it on a daily occurrence now, but I do.
I loved it, by the way.
Shocker to everyone listening, that anyone listens to us. So let's analyze that. So let's look at, right, I always make the joke, when you're making a pie, if you have too much flour in the pie is going to suck. So let's look at the mix of a portfolio. So I'm going to put down a standard portfolio that we see all the time. 40% in some sort of large blend type of asset class, right? Maybe they've got 5% in some sort of small blend. They've got another 30% in international. They've got like corporate bonds, and they've got 5% in cash. See this all the time. 75-25 allocation. So from the standpoint of risk, they're thinking, okay, 75% is in stocks, 25% is in bonds or cash, so relatively, hopefully safe. And they're wanting, and so we show them what risks they're actually taking. Well, let's just look at a quick pie chart. You're looking at this pie chart, and you're seeing 40% of this person's $1 million is in large blend. Like that in and of itself, at least for Alex and myself, is not our definition of diversification. And we look at the risk profile, right? Average return of 9.45 with a standard deviation of 14.42. Well, what does the 14.42 actually mean? Well, what that means is with the $1 million portfolio and taking it out to the third deviation, which is 99.7% probability, that $1 million, that client has to be okay with losing, and I'm rounding up here, $350,000 in any given year, with the possibility of gaining $500,000. So imagine being close to retirement. You've got $1 million, and in any given year, you could lose $350,000. Is that the risk that you signed up for or even knew about?
9 times out of 10, clients say, I didn't sign up for that, or I didn't know I was signing up for that.
So then we look at it, and again, it's portfolio construction, diversification. When we start adding what we're talking about here, I'm just going to choose a standard template that we would, again, this is high level. There's a little bit more to the weeds into this. It's just keeping it simple for today's episode. What we did is this. We lowered the large blend from 40 to 29%. We added more small. So we went from 5 to 12. We changed the 30% international large blend to international large value. And because we know the small company added more risk to the portfolio, we offset the risk by doing government bonds, not corporate bonds, but government bonds, United States government bonds to be specific. And as you can see when I close here, pretty much the same risk.
The same 75-25 portfolio. We just mixed it a little bit differently.
But if we looked at, on average, what this has done over periods of time, we're looking at a full 1% more rate of return. Now, again, we're not guaranteeing this. We're just looking at historically what it's done and understanding really taking an academic approach towards investing. And this is where we separate ourselves from the standpoint of, well, we just shared with you that the small value category over long periods of time has done rather well, and you barely had any of it in your portfolio. And we're not over concentrating. It's not like we went from 40% large stock to 40% small.
Right.
Again, it's the mix of the portfolio. And now you can see how that changes.
Well, and none of the portfolios are put together with a backwards looking view. They're all put together with a forward looking view of what do we expect the rate of return to be? Why do we want to invest in these different components? And how do they work together to either increase the return probability or decrease the amount of risk that we're taking? And really, it's dependent upon the client as far as, okay, what is it that you want? And then let's figure out how best to do that. And there's really about 2 or 3 different ways to go ahead and accomplish each one of those things. And it's really then just, okay, hey, let's look at doing this. Let's look at adding that. Let's look at changing this around. And so we, basically help the client build out a portfolio that fits with what they're trying to accomplish. And we look at it from an expected rate of return and a risk standpoint.
So to review the 3 mistakes that we see, we've got over-concentration, we've got overlap, and then we've got proper diversification, or what we would call poor diversification is the mistake made, because very little small companies, very little international, or if we do have international, it's all in one asset class, right? That diversification is key, because if you look at, like, let's just take right now, Alex, like the S&P right now is up like 8%. Maybe it's up higher. I haven't looked today, right? So that's the U.S. large. And people might be saying, well, it's up, doing well this year, Ryan, or it's done well over the last couple of years, Ryan. Well, when it was down this year, people weren't saying that. And if you looked at international small value, that category, I think, is up 20+% this year.
And it was one of the most ignored categories around.
So walk me through when you knew to shift to international small value. Like you just can't time that, which is why proper diversification is key. Because imagine some version of '01 occurs, right? The tech bubble or something like that. The S&P crumbles. Well, if you've got these other asset classes, it helps lessen the blow, which hopefully allows you to stay on plan and not hopefully have you freak out even less. And hopefully you've got a professional you're talking to at the same time.
Right. When some people are probably saying, oh, well, like those black swan events, like 2001, 2002, 2008, when, they were flying planes into buildings, or, the pandemic or the Great Recession, those are black swan events, and everything went down. A, not everything went down. And B, that's all the more reason to have proper diversification, is that we've experienced 3 black swan events of seemingly like should only ever happen once in our lifetime events. And we've experienced 3 of them in the last 25 years. So it's one of those things where we need to be aware of this and make sure that we are investing appropriately, not just driving in the rearview mirror, looking at what did well last year, or what's done well recently, but what do we expect to do well going forward, and how do we actually build a portfolio to go ahead and make sure that we're looking out the front of the car, not trying to drive in the rearview mirror.
So that's our episode today. If you got any questions, concerns popping up in your head, head over to beerandmoney.net, and at the top of the page there's a contact us. That's a great spot to reach out with those questions. Or if you have a topic on your mind, that's a great spot to send that our way for us to discuss. Look, we started this podcast to help you think differently about your money for the purposes of you building the life that you want and the goals that you have. And we're taking the academic approach and a holistic approach, and a truly holistic approach, rather than chasing return. We hope this episode was valuable for you. And as always, Mr. Collins.
Cheers.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities, LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities, LLC. OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
8223102.1. Expiration date July 2027.